All right, real estate junkies, it is time for Mike's market update. We are in the month of December. As normal, we'll start off with some macro information. When we get into the actual real estate numbers here locally in Portland, that's going to be for data through November 2020. So let's go ahead and jump right in. Macro update. It is now official. Joe Biden is our president in waiting. So let's kind of get an idea of what we can expect from an economic standpoint with Biden's presidency. So, no secret at all, he campaigned on repealing the tax cuts that Trump made for individuals making $400,000 and more. He also wants to do some different treatment for capital gains. He wants to increase minimum corporate rates. And that plan is supposed to bring in another $3.3 trillion over the next decade. On the positive side, millennials will be happy. This is also good for the housing market. He wants to create the first-time homebuyer tax credit. What's different about this first-time homebuyer tax credit than what we saw come out of the Great Recession is this will be refundable and advanceable. So the previous tax credit that came out during the Great Recession was only refundable. So you'd have to buy a home, you put that down payment down, and then you get a tax credit for, it was $7,500 back then. So not only is he doubling the amount to $15,000, but it can also be advanceable, meaning they can give you an advance on that money so you can use it for your down payment. So that will affect our real estate market. One of the hottest markets we have is the sub $400,000 market here locally, and that is that first-time home buyer sweet spot. With the really low interest rates paired with this tax credit, we could really see some upward pressure on pricing in that first-time home buyer market. And then student loan forgiveness without tax liabilities. So student loan forgiveness has been a discussion going on for a while. Biden wants to make that without a tax liability going along with that. Unhappy boomers and real estate investors. So these are the savers. These are the people that are currently holding wealth. Long-term capital gains increase and removing the step up in basis is going to be huge to the real estate market. So to get an idea of the long-term capital gains treatment, for capital gains in excess of $1 million, he wants to make that taxable at your ordinary income tax rate rather than the previous federal rate, which was 20%. So that can essentially go from, for these individuals, can go from 23.8% to 43.4% just on the federal level for capital gains. So that's going to make these people rethink how they start dealing with real estate. Along with that is a removal of step up in basis is his proposal as well. So that contradicts each other. So if you're going to be looking at more capital gains, that would make you want to just not sell a property and then let your next of kin inherit it, get their stepped up basis and move forward. But if you remove the stepped up basis and now there's no tax advantage to hold it on and just die with your real estate, that may then realize itself in baby boomers actually selling real estate, paying off the capital gains, and then just having money that they can now gift out to their next of kin, or they can spend away, or they can put into other types of investments or saving plans. So it'll be interesting to see how this shakes up the real estate real estate industry. He also has changes planned for the real estate industry deductions. So we're talking about depreciation and whatnot for professionals. So his presidency will change the tax landscape for real estate investors and real estate professionals. He also wants to expand the gift state tax back to the 2009 levels. So baby boomers aren't happy. That's just something they're going to have to deal with. Happy parents, increase in tax credit, and then increase in the reimbursement rate from 35% to 50%. So if you've got dependents, then you're going to be able to see better treatment for that on your tax return. And kind of at the end of the day, no matter what Biden does, everything that I've read from his tax plan predicts a slowdown of GDP. But when you're looking at how we're resetting our long-term debt cycle, how we're printing all this money, how we're going to have really low interest rates, that's going to affect asset markets, capital markets. And that's typically the way that economics will get measured from a presidency. He's going to benefit from the inflation, so that inflation will outpace the projected reduction in the GDP. And the way that we're doing the monetary policy, this printing of money, along with fiscal policy from the stimulus, that's going to work together to devalue our currency. So that's going to make assets worth more. So when you look at his presidency from an economic standpoint, when he's done, whether it's 4 years or 8 years down the road, he's going to look like he did well from an economical standpoint. Political BS stimulus update. Let's just get back into this. I've got a lot of headlines to go through. So challenging times ahead. This stuff came out in November. Just recently, December is going to be the deadliest month by far from the US standpoint from COVID. Last month, Mnuchin and Powell started clashing over emergency lending. So with the CARES Act, that opened up a lot of emergency credit facilities, lending facilities from the Fed. In the CARES Act, the language wasn't specifically clear on whether those facilities should end by the end of the year. Mnuchin started taking back money. I think it was about $480 billion that he took away from the Fed for those policies, saying that that was part of the CARES Act meant we needed to stop those facilities. This money wasn't lent out, so we're taking it back and we're going to add it to their general budget for the Congress to decide how they get spent later. More talks on the stimulus. The White House, once the presidency looked like it wasn't going to go Trump's route, he essentially pulled out his negotiators back in November. More warnings that COVID pandemic is accelerating everywhere. No state's going to be safe. We did start seeing talks get back into place for the stimulus, and we'll get into that and what that means. Buffett last week came out and urged Congress to extend PPP to help small businesses. House leaders say they'll act to avert a shutdown. So what we have going in the stimulus now is both sides of the table are coming back in. The White House has been coming into negotiations, the Senate's coming into negotiations, and the House of Representatives has come back into negotiations. They're now talking about a $900 billion plan, and this is kind of a stopgap stimulus funding standpoint. Biden's comments a couple of weeks ago came out and said this will be a down payment on a larger package. Essentially, all of our leaders know that we need to get PPP going. We need to fund more in the airlines. We need to get funding for vaccines, treatments, testing, that type of stuff, funding for schools so they can get back up and going. But they're still continuing to fight over aid for cities and states and local governments. And they're still fighting over liability protection for employers. So the Democrats essentially want to have significant amount of money for local government funding. The Republicans want to have liability protection for businesses opening back up. They're not seeing eye to eye on that. That's what's really pushed a stalemate in getting this package done. The latest versions of the $900 billion plans are essentially removing those two items. What is the sticking point now is what we just talked about was Mnuchin pulling money back out of the Fed and stopping those emergency lending facilities. So what came out yesterday, December 17th, was now some Republicans saying, I'm not going to move forward on a stimulus bill unless the new stimulus funding has verbiage that shuts down those emergency lending facilities. The way that they're written now, the Fed can essentially open those back up whenever they want. Democrats want to allow the Fed to essentially have access to those emergency lending facilities all the way through 2026. The Republicans want those emergency lending facilities to stop. So that's the sticking point now. The other issue that we have in the negotiation is the government is running out of funding as of today. So we're looking at a government shutdown potentially this weekend if Congress does not get their act together and pass more funding at the government level. And they've been trying to work those two packages together, essentially saying, hey, we'll pass stimulus if we can pass this government funding stopgap funding scenario. That hasn't happened. It doesn't look like stimulus is going to happen this week. So we're going to look at a temporary stopgap funding at the government level to keep the government going and then potentially negotiate stimulus. I was of the opinion back in November that stimulus would not get funded until the end of January. They did start making a push. There was some conversations going, and it looked like we may get some temporary stimulus passed by the end of 2020. That's still up in the air. Leaders are saying they want to get that done, but they've been saying they've been wanting to get this done since August. So we'll see what actually happens on the stimulus level. What is still being negotiated is, are there going to be direct checks to citizens? One of the packages that's being considered does, the other one doesn't. And then also what's happening from a federal level on the unemployment checks as well. It's looking like that will be about $300 a week. That will be agreed upon by both sides. So we'll see where it goes. We do know that more PPP will eventually come for small businesses. It's just a matter of, will it get funded prior to the end of the year, or will it get funded in January when that stuff passes? So expect PPP to come. Expect at some point direct checks to citizens will come. It's just a matter of when will they get passed, and will it be two packages or one package? It's very much looking like we're going to have two more stimulus bills come across our plates in the next month and a half, 2 months. So we'll see where that goes. Mortgage credit availability index. I always want to see what's going on in the mortgage world, because that parlays directly into how our real estate market's going. We had another increase. So last month we saw an increase. We saw the steep decline. We saw one brief increase in I think May or June, and then decrease. Last month we saw an increase, and this month we saw an increase. So that's really good news. When you look at interest rates being really, really low, lending availability is increasing. That is very good for our real estate market. Also, forbearance is decreasing. Now, forbearance is a little bit of the devil is in the details in this. And so people are coming out of forbearance, but it doesn't necessarily mean that they're getting back on track with their loans. And so what we're seeing a lot of loan modification applications. This is one thing that I've kind of been predicting from the outgo, which is we're not going to be in 2008 a huge foreclosure rush. Lenders are going to be more desirable to work with loan modifications. We understand how loan modifications work. With the Great Recession, we were able to show that we can do a significant amount of loan modifications on a volume basis. The politicians would like to see loan modifications. There will be funding available for this. I see more loan modifications coming, but that is the big reason that forbearances are decreasing. Isn't because people are just coming out of forbearance and the economy's back up and roaring and we're good to go. It's because they're getting towards the end of what their forbearance was going, the time frame on their forbearance, and now they need to do something, and that's pushing them into loan mods. What we actually saw last week was an increase of forbearance applications back to the levels they were in April. So we're actually looking at another wave of forbearance now that we made it through that first window. So it'll be interesting to see what happens there, but we're still in the middle of a refinance boom. When we get into the local numbers, demand is super strong, effective purchasing is super strong. So the mortgage market is functioning. That's keeping our real estate market functioning. And as I've said time and time again, we absolutely have to have our real estate market function to help pull us out of the depression that we're in, or the economic state that we're in. So let's get into a micro update. Some opinions on the local election back in November. So Mingus Maps won. He was going against Chloe Daly. Dan Ryan, he was elected. He wasn't part of the general session. He was elected in the spring. And then Ted Wheeler was renewed. So he won as well. So this is a huge win for housing providers. And it's not because they are wanting to put forth landlord favored or housing provider favored legislation. It's that when you look at the alternative of what we could have had Chloe Daly, we could have had Margot Black, and we could have had Sarah Iannarone. Those three ladies, along with Joanne Hardesty and Carmen Rubio, I think is her name, they would have been extremely pro-tenant focused. And so when you think of the other things that Chloe Daly wanted to get done, which is first right of refusal to purchase, allowing the tenants to purchase a tenant occupied property before it could go to the open market, or allowing the city to purchase rental housing before they could go to the open market, that's huge. And then they've got other things that Chloe Daly wanted to get passed. So this will just stop the focus on continuing to change landlord tenant law here locally. So less focus on housing provider regulation. Now, that doesn't mean that they're going to stop making more tenant protections a focus. So Wheeler was the one that put forward the mandatory relocation policy to be any rent increase. So $1 rent increase triggers mandatory relocation policy. That was Wheeler that pushed that forward. So we're still going to have a city council that wants to see tenant protections in place. But instead of really focusing on changing law, they're just going to maintain what's really been done, aside from really getting us through the eviction moratorium, getting us through the COVID effects. There will be more focus on homeless and income inequality. So right now they're dispersing the rent assistance that came out of the CARES package. That will be all dispersed by the end of December. Affordable housing bond money will start to flow. So we'll actually start physically seeing buildings being built. It takes a while to process the funding on affordable housing, then the permitting, then the building side. We're actually going to start seeing units being delivered from those housing bonds that we passed over the past few years. There will be a focus on mental health services. There will be a focus on women and minority-owned funding for businesses. And then what I also expect to see is East County development. So if you look at how we've changed development policy, when you look at the residential infill project policy, there's been an understanding that East County development needs to get funded, but a reluctancy to fund development in East County because of how that creates gentrification, displacement, and whatnot. So look for developments to happen there on the East County and start seeing the physical nature of those neighborhoods changing, and then protections in place. For an example, what we could see is mandatory relocation, having some overlays in it to have higher funding levels for people that are in East County. Not saying that's going to happen, but that's been something I've heard being discussed. So we'll start seeing that take place in the next year. Just yesterday, I think it was yesterday, Multnomah County approved a 6-month extension of the state of emergency, which then extends their eviction moratorium. So that's now into July. And then tenants have 6 months to pay back anything, any of their deferred rent. So tough times again, more for housing providers. It's not looking like it's going to end anytime soon. The state level, so Governor Brown has called a 1-day special session, which will happen on Monday. And at the state level, they're talking about expanding their eviction moratorium as well. So we're not nearly out of the neck of the woods from a housing provider standpoint. If you've got tenants that are not paying rent, it's going to be a long time before you can really expect to see any money out of that. So we'll see what happens there, but let's go ahead and get into our numbers. So here's the PDX real estate report. This is based on numbers from the RMLS market action. Wow, active residential listings. So you can see in the past, we have the lowest amount of homes available for purchase. So actual inventory available for purchase, the lowest we've seen in 5 years. And I think this might be historically the lowest we've ever seen from an inventory, actual housing properties on the market that are available to purchase now. New listings, you can see we've just kind of fallen back into that normal cycle of sellers, of the amount of sellers coming to the market. We saw fewer sellers come to the market early on in COVID as we were trying to figure out how do we list properties. As we started to figure out how to operate as a community, that number got back into kind of a normal or somewhat close to a normal before it started slowing down again. We saw a quick bump in October of, hey, some sellers are coming to the market. I was really expecting to see these orange dots a little bit higher than normal as we got through the winter. I just expected to see more sellers coming to the market. However, when you start shutting the government down, when we start seeing COVID cases hitting record numbers, cases and deaths hitting record numbers on almost a daily basis now in the state of Oregon, that makes sense that our sellers are just not coming to the market. On the other side, though, demand's been strong, right? So we've got 1, 2, 3, 4, 5, 6 months in a row of more pending sales than we've seen in the past 4 years. And so when you have new sellers not coming to the market, and when you have demand strong on the pending sales, and then the same thing for closed sales, demand strong on the closed sales side, then that just results in record low supply levels, right? So supply levels are a function of homes available to purchase, and the absorption rate, how many homes are selling any given month. And so 1.1 months was a record low. That was followed up by a record high, and then now a new record low. And typically we start seeing supply levels fluctuate during the winter. And that's just because we have less volume. When you have less volume of sellers, less volume of buyers, that number consistency just isn't there. I kind of do expect, or I expected supply levels to start increasing at some point. It's just not happening. And that's because our sellers aren't coming out and demand staying strong. And when you look at demand from an interest rate level, the Fed is committed. So they had a meeting just yesterday, or results from a meeting. They're committed to keeping interest rates unchanged through 2023. They've also committed to keeping their bond purchasing. So I think they're spending $120 or $150 billion a month in buying paper. So buying treasuries, buying mortgage-backed bonds. That puts downward pressure on interest rates. And so when our Treasury note rates yields continue to stay below 1%, then we can expect interest rates to stay below 3%. And that is what's fueling the demand side of it. And that's what's putting upward pressure in pricing. So marketing time, we're starting to kind of see that little, very small change, but an uptick, which we typically see during the winter months. And it's a small uptick. You can see the pace is different than it normally is. And that's because our supply levels are so low. When we look at our appreciation, you look at year-to-date numbers around 7%. That's about double what I think it should be. And low interest rates are having an effect on that. When you look at October, why does this say October? It should say November. This should say November. But when you look at the year back, so this time in 2020 compared to the same time in 2019, we're up 10 and 12%. So that's significant. And that is a direct correlation of how easy money is, how low the interest rates are, and what that leads to what you can afford from a housing price standpoint. So from our market, expect it to continue to be a hot seller's market. Expect buyers to be fighting over themselves. Expect that inventory is going to be under supply levels will be under 1.5 months of supply. Expect interest rates to stay low. Once Biden gets in control, and once we start seeing first-time homebuyer tax credits come back, we're going to see a huge push in valuations on the first-time homebuyer market. So right now, that $400,000 and less market segment for first-time homebuyers, I wouldn't be surprised to see if that gets pushed up to 425, or potentially 450. $425,000, $15,000 down payment, or a $15,000 first-time homebuyer tax credit, that essentially is your 3% down payment for a $425,000 home. So that's going to line up really well with FHA lending. And then that low interest rate allows you to have a larger mortgage. And so when we know that all buyers compete based off monthly mortgage payments, that just allows them to increase their offers 5, 10, 15, 20 grand, because the effect on their mortgage payment's so little. And when they're getting their down payment given to them, now they don't have as much money out of pocket to close as well. So that is our market update for November. Look forward to January. We're going to be doing a market forecast. So I'm starting to compile data and my thoughts for what's going to happen in 2021. We'll review my forecast for 2020. I don't know that anything came true, but that's okay. We're not always right, and it's okay to be wrong, and things happen and markets change, and we just do our best to stay up to date with them as we move forward. So look forward to our market update in January, and then a bigger market forecast for 2021. So go out there, be amazing real estate investors. With that eviction moratorium extension, expect a good time to buy tenant occupied property. You'll just have to figure out how to process the pitfalls with that eviction moratorium going forward. But there's definitely opportunities out there. Great time to bring properties to the market to sell to owner occupied buyers, and a great time to go buy tenant occupied properties. So there's my take. We'll see everybody next month. Thanks.